Look at the headlines today, and it feels like the world is on fire. We see geopolitical tensions, energy spikes, and those flashing red numbers on our screens. If you're a rational human being, your instinct is to hide, to pull your money out and wait for the all-clear signal. But here's the cold, hard truth about Wall Street. The all-clear signal is the most expensive sound in the world. By the time you hear it, the profit has already been made. Today, we're in March 2026. Gold is hitting record highs, the S&P 500 is dancing with volatility, and everyone is asking, is this 2008 all over again, or is it 2003? Today, we're going to look at the chaos paradox. We're going to compare the current 2026 AI leverage era to the 2003 Iraq war crisis to see why the stock market is often a cold-blooded contrarian. Let's hop in a time machine back to March 2003. The US was about to invade Iraq, the dot-com bubble had already popped, and the market was bruised. Fear was everywhere. People assumed an invasion would tank the economy. But do you know what actually happened the day the invasion started? The S&P 500 didn't crash, it rose 2.3%. By the end of that year, it was up 30%. Why? Because markets don't hate bad news. They hate uncertainty. Leading up to the war, the not knowing was the poison. Once the first boots hit the ground, the uncertainty became information. The market priced in the conflict and looked toward the recovery. It's a pattern we see over and over. The Pearl Harbor shock, the 9/11 dip, the 1990 Gulf War. On average, the market bottoms about 3 weeks after a major geopolitical shock and recovers in less than 2 months. Now let's look at right now, March 2026. Our chaos looks a little different. We aren't just dealing with tanks and drones, we're dealing with AI leverage. We've seen the S&P 500 hit nearly 7,000 earlier this year, driven by an AI supercycle. But underneath that hood, things are getting weird. We've got tech companies moving $120 billion in data center spending off their balance sheets. We've got gold surging past $5,500 an ounce because central banks are nervous about the dollar. In 2003, the fear was the war. In 2026, the fear is the plumbing. If 2003 was a geopolitical shock, 2026 feels more like a concentration trap. A few massive AI stocks are holding up the entire roof of the building. If they slip, they don't just fall, they pull the whole neighborhood down with them. So how do they compare? In 2003, we had a valuation cushion. Stocks were actually cheap because they had been beaten down for 3 years. In 2026, we don't have that luxury. We are trading at high multiples. We are priced for perfection. But here is the common thread. Oil. In every major crisis, 1990, 2003, 2022, Ukraine, and now the 2026 Iran tensions, the real killer isn't the headline. It's the gas pump. When oil spikes, it acts like a global tax on every human being and every business. If you want to know if 2026 is going to be a buy the dip moment like 2003, stop looking at the news and start looking at the Strait of Hormuz. If oil stays contained, the market will likely do what it always does. Shrug off the tragedy and keep climbing. If oil stays above $100 for months, then we aren't in 2003 anymore. We're in 1973, a deep, sticky recession. So what do you do with this? First, recognize that the market is not the economy. The economy is how we feel. The market is a giant machine calculating future earnings. History shows us that if you sold your stocks during the Iraq invasion in 2003, you missed one of the greatest bull runs in history. If you panic sold during the 2022 invasion of Ukraine, you missed a 60% gain in the S&P 500 since then. In 2026, the smart money is doing something specific. Tactical rebalancing. They aren't leaving the market, but they are moving away from the concentration trap of US megacaps and looking at international markets or hard assets like infrastructure. They are preparing for a managed disorder, a world where things stay messy, but the wheels keep turning. The lesson of the last 30 years is simple. Don't bet against human resilience. Whether it's 2003 or 2026, the world finds a way to trade, to build, and to grow. The headlines are designed to make you feel. Your portfolio is designed to make you think. Keep those two things separate, and you'll find that even in the middle of a crisis, there's always a path forward.